Google is set to report earnings on October 29th after the market closes. The stock is already up about 58% over the past year. So the question is now a good time to buy? Let's take a look at the fundamentals and run a discounted cash flow model to estimate its intrinsic value and potential future returns. Google's financial growth over the past decade has been nothing short of remarkable. Revenue has climbed from $74 billion 10 years ago to roughly $371 billion today, a nearly five-fold increase. Looking ahead, analysts expect this momentum to continue, projecting revenue to rise from $406 billion in 2025 to around $616 billion by 2029. Profitability has followed a similar trend. Net income has grown from $16 billion to $115 billion over the same period. One area of slight concern is free cash flow, which currently stands at $66 billion, still strong but growing at a slower rate compared to net income. And analysts forecast EPS or earnings per share to grow from $10.23 this year to $18.27 per share by 2029, representing solid double-digit annual growth. I agree with this optimistic outlook. Google has several catalysts that should continue to drive both revenue and profit higher. If we look at revenue by segment, Google is growing across all major business lines, which are Google Search, YouTube Ads and Google Networks, Google Subscriptions and other revenue, and most notably, Google Cloud is a standout performer, growing at 30% annually. Geographically, growth is also broad-based. The company is expanding in Europe, the Middle East, Africa and Asia, where there still is significant untapped potential, especially in the developing regions. Lastly, Google has amazing margins, with gross margin being at 58%, profit margin at 31%, and free cash flow margin is obviously lower as we have seen, and it is at 18%. Then, in order to calculate the intrinsic value of the company, I use my DCF model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And according to my bear case, the intrinsic value is $137 per share, middle $219, and high $333. And because the stock is currently trading at $266 per share, this means that if my low assumptions occur, you would get a negative 1% annual return on your money, middle positive 6.7%, and high 13.9%. By the way, these returns include the dividend, although it is very small as the yield is only 0.32%. As far as my assumptions, I assume Google grows revenue between 7 and 13% over the next 7 years. They average a profit margin and free cash flow margin between 20 and 30%, and I assign a PM price to free cash flow at the end of the 7 years of 20, 22, and 24. Moreover, they are currently trading at a price to free cash flow of 47, the most expensive in a decade, and therefore their stock looks a bit overpriced. But Google has a perfect balance sheet with $96 billion in cash and only 41 in debt, which is nothing for a company of $3 trillion. And even though competition in the AI space is intensifying, I believe Google will continue to grow alongside it. The company's strong fundamentals, diversified revenue streams, and leadership in areas like cloud computing and search give it a solid foundation for long-term success. However, the current valuation looks a bit too high for my liking. While Google remains an exceptional business, if you pay too much for an investment, your returns will suffer. Lastly, if you want a discount on stockanalysis.com, the best site I found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Google stock in the comments, and I'll see you in the next one.